If you ever find yourself opening the charts at the start of your trading day and not really having an idea of where the market's going to move in that day, then watch this video to the end and you should have a better understanding of that. Because in today's video, I'm going to be talking about a concept of directional bias, mainly daily bias, looking at the higher time frame trend to work out where the market's going to move next. And if you haven't really considered this before, then it is really going to change how you look at the market and really increase the amount of trades you take that you get the directional bias right. So if you're someone that's just been looking at like the 15-minute charts, the 5-minute charts, just taking each day as an individual day and trying to catch repeated patterns that have happened before and you hope will happen again, then you're just going to be trading all over the place and you're not going to be trading in line with the higher time frame trend, which is where the big banks and institutions are trading. They're not looking at these smaller time frames, they're trading long swings on the daily, weekly time frames to catch long moves, open positions that last months, and just re-enter positions on the pullbacks that they create. Obviously, this goes without saying, but just to make sure you're clear and you understand it, just because you have a daily bias doesn't mean that the markets are going to move in the direction that you think they will. Obviously, it's not just up and down, and you can't predict the direction completely. Obviously, there's days like this. Yesterday, Friday the 30th, obviously the end of the year, so there's going to be a bit of all over the place, but some days aren't trend days, most days aren't trend days, but on the days that are trend days, you can catch the big moves in the direction of your daily bias. But for here, you've got this just consolidation, just range, liquidity being taken out on both sides, not really much movement until the end of the day where we got a bit of an uptrend. But there will be moves where you get big trading days, nice bullish day, nice bearish day, nice bearish day. And what we're going to be talking about in this video is how you could have been able to predict, well, not predict, but catch all these down moves on the days. So this is a 15-minute time frame. Obviously, I know a lot of you like to scalp on the lower time frames, and so this will help you with that. So I do hope you learned something from this video. So obviously, being a daily bias, the first thing you're going to want to do is go to the daily time frame. Just look at the most recent stuff, and I've got a few set of rules and checklists you can go through to get your directional bias. These are the rules that the checklist that we're going to go through. Step 1 is locating liquidity sweep. Step 2 is marking up the target buy side liquidity or sell side liquidity, depending on which bias you have. Third step is marking up the imbalance and order blocks if you see any key order blocks. Then step 4 is distinguishing between premium and discount levels. You may have heard me talk about that in the Fibonacci level. This is a bit different. We're not looking for extreme premium and extreme discount levels. We're just looking at above and below equilibrium. So the 50% level between the last move, I'll go into more detail about that. And then step 5 is either entering using one of the strategies that I've got on my channel, or your own, whichever you like, either on this daily time frame, or if you prefer scalping, you can go down to the hourly, the 50-minute, the 5-minute, whatever you want, whatever suits your personality and trading style. But let's run through the checklist. So step 1 is looking for a liquidity sweep. If you don't know what that is, you've got liquidity above all these lows and highs. There's liquidity, and what you want to see is price break above and then pull back down because liquidity is being absorbed. So as you know, there's liquidity resting above highs like this and this high over here. And so when that gets absorbed, price is going to shoot above it and then shoot down. So obviously you could be looking at any of these highs for a liquidity sweep. For example, here, you could call this liquidity sweep back at the start of December. This might have given you your daily bias, but for now it's going to be concentrating on the most recent one, which is going to be this high over here. You can see it gets nicely swept over there. So as you can see, price, let me just zoom in a bit, price shot up and then a big bearish engulfing candle to shoot price down and cause a change of character here. That's not always necessary, but it's a nice confirmation. But you can just see changing market structure from bullish to bearish. Obviously, you can use market structure to get your daily bias as well. As you can see, we're in big bearish, but this is going to be looking at more SMC stuff rather than technical analysis and price action. So as you can see, step 1 done that. Liquidity sweep has been located, and now step 2 we're going to be marking up the target buy side liquidity or sell side liquidity. So another thing you can call this is buy side liquidity. It's called that because above this place is going to be buy orders, people trying to get breakouts, and people with who have gone short with their stop loss. Stop orders are going to be buy stops. So this is all the buy side liquidity, and so we're targeting sell side liquidity now. So that's what we're going to be marking up in step 2. And sell side liquidity is just going to be liquidity below all of these highs. Okay, so this is what I've marked up as my sell side liquidity. You could class this low here as having some liquidity, but that's not going to matter too much because of step 4. But for now, anything that's got a low that you can see a clear higher low in this kind of pullback uptrend, you can mark as sell side liquidity. It's not too important, but just as you can see, there's a lot of sell side liquidity, which means that it's going to be the institution is going to be targeting that. They're going to want to push price down to take out all of the stop losses that are below here. People trading the trend line. They're going to place their lows below all of this. So there's going to be a lot of orders and a lot of liquidity to be taken by the big institutions, which is what we want to trade with. Again, imbalance, another SMC concept that you should know what it is. If you don't, I've got a video on it, but it's just going to be these gaps between anytime there's a big candle and there's some inefficiency in price being filled. There's going to be gaps between the wicks of candles, like here. And as you can see, it gets filled. So just like, for example, here, balance gets filled before price goes up again. Sometimes it doesn't, which means price will come back but down eventually to fill some of it, all of it, take it out, whatever it wants to do, but it will get filled again here. Some imbalance gets filled, and then price goes up. But to me, maybe I'm missing something, but that looks like the only fresh imbalance on this chart at the moment. There's some up here on the other side, which you can mark up as well. Okay, so I've just labeled it IMB, just keep everything short and kind of clean looking. So as you can see, step 1, done, step 2, done, step 3, done. Now step 4 is going to be distinguishing between premium and discount levels. So we're looking at this whole downtrend here and then a pullback in the uptrend. And so we're going to take our fib tool, I'll show you the settings in a minute, from this low to this high, mark it up, take off everything other than the 0.5, the 0 and the 1. I mean, you can take off the 1 and the 0 as well if you want, but it doesn't really matter. I'll leave them on for now. So the theory behind this is everything above the 0.5 is the equilibrium level. This is where price is going to tend towards. Everything above this level is premium and everything below this level is a discount. So for example, when you're in the trading range, you're not going to want to take buys above the 50% in the premium, and you're not going to want to take sells in the discount. You're going to want to be looking to buy in this discounted area, and you're going to be looking to sell in this premium area. That's not entirely true, because obviously you don't want to be buying around here anything near the 50%. You want to be buying in, like, split it into thirds, and you want to be selling in the top third, buying in the bottom third when you're in the trading range, if you can trade them. I can make a video on that, but for now, let's ignore that. Key concepts about step 4 is set this up. You're going to be want to selling in this premium area and buying in this discount area. So any imbalance here that you might look to buy from, or this big order block here, you're not going to be wanting to do that because it's above the 50%. So we can get rid of this and sell liquidity. But this imbalance here, that's quite good. We could sell from that, sell from this order block here. Got a nice daily change of character. Coming on to step 5 is where you could enter. We could see something like, you can see price, create some inducement, either tap the imbalance and shoot down, or it could do that, touch the order block and shoot down. Anything, the market does what it wants. It might just do this, miss the imbalance and shoot down anyway. That's why you just got to be able to react, and that's kind of the purpose of having a daily bias. It doesn't matter if you miss the moves on the higher time frame, you can still catch the daily moves in all these candles. So, you've got a lot of bearish days which you could catch moves from somewhere near the top and write it down. That's the goal of this strategy. And then obviously when you're targeting, you can target any of these sell side liquidities or your set risk reward, depending on how you like to trade. Because obviously the lowest sell side liquidity might not get taken out. We have been going down just fundamentally. Will the GBP USD reach parity? Maybe, maybe not, more likely not, but obviously that depends on the fundamentals and what happens at the news events. So just to recap what you're going to be doing on the higher time frame, and then I'll get onto the lower time frame to see how you're going to use this to get some entries. Step 1, locating liquidity sweep. Done that here. This is where the buy sell liquidity was taken out, and then price shot down, broke structure, showing a shift in market structure. So now we're looking bearish. Your daily bias is always going to be in the opposite direction of the liquidity sweep. So if you've taken out the buy side liquidity, you're going to be looking to short. If you've taken out the sell side liquidity, you're going to be looking to long. Step 2 is marking up the opposing buy side liquidity or sell side liquidity. We did that with all these lows, weak lows, where there's liquidity resting below them, because retail traders have their stops there. Step 3, marking up imbalance. We did that. We removed one here, marked the one up there. You can mark imbalance on either side. Normally there will be a bit more than what there is here. Obviously, the more the better. So that's where price is going to target. And then distinguishing between premium and discount levels, easy, fib from the bottom to the top, with 0.5 in the middle. Everything above is premium and everything below is discount, where you're looking to buy from the discount and sell from the premium. And then step 5 is enter. And as I mentioned, you can even enter on this higher time frame. So if I just remove this, if you've watched my change of character video, you will know that this order block here, you could get a daily time frame entry on entry there, entry on the wick of the order block, and then you can target these lows here for a 3.42 if it goes straight back up. If it continues down for a bit, you can target more. Or if you want to hold your trades for longer and you want to ride this trend down, you want to swing trade or position trade, then you can catch a nice bigger trade for 1 to 9.8. If you don't want to trade these hard time frames because it does take a while for stuff to happen and you're not going to be entering many trades, which isn't a bad thing. You don't want to be over trading, but if you prefer trading intraday, then we can go to the lower time frames. I'll just delete that. As you can see here, this is the 15th of December where you get this huge bearish candle, which shows that liquidity was swept. So anything after the 15th of December, our daily bias is now bearish. So we can go down to like the 15-minute. We'll go to the 15th of December. So this was the big bearish day. And then after anything after this, you can be looking to go short. So for example, wherever your entry is, there was a nice move, nice bearish move down here. Not the best, not the cleanest day, but you can easy order block entry here, liquidity taken out, quite a big order block. Maybe you could refine it or get a nice entry there. Bit of a bearish move down to these lows. It's not going to be the highest risk reward, but you've got your bearish daily bias. So whatever your entry strategy is, you can implement it into the markets now with only looking at one direction rather than trying to guess whether it's going to go up or down. Again, then on the 19th, nice entry opportunity here. Got some liquidity resting above there. Price sweeps up, shoots down, and maybe there was a 1 minute entry or maybe a 5 minute entry. You got in there, ride this all the way down to the Asian lows. Or this order block over here. If you do want a video on possible entries, different entry methods, then do let me know in the comments if there's anything you're struggling with and I can make a video on it. As I said, here, 20th December, not every move, not every day is going to be in line with the daily bias. Here you just get not really much going on, but you're not going to try and go long, even though you could get a long entry from here. You can just ignore those days where it's not aligned with your daily bias. Then a very nice trend day on the 21st. Easy setup, it's probably a nice 30-minute order block or a different time frame, but it gets tapped. Perfect entry, sniper entry, write it down, and let's see what this would have been. Obviously this is looking at in the past, but I don't see any reason why you wouldn't be able to get in this trade. 4% trade, very nice. It is just backtesting and doing the same thing over and over again, because you will lose and you just need to learn from it. See if there's anything you did wrong, because sometimes there will be, sometimes there won't. But yeah, this is nice. I mean, obviously you wouldn't go down to the bottom, but just those lows, 4%. The next day, 22nd, Asian highs taken, and a very nice order block here that took out liquidity, huge engulfing bearish candle there. Yeah, and then you would have had to get in quite quickly, but no reason why you couldn't. Write it down to Asian lows, that's 2.7%. Write it down all the way, it was a 7% move in total. If you somehow managed to get it to the bottom, which you wouldn't, but anything, whatever your risk reward is, 1 to 5, that would have been easily doable, 1 to 4, whatever it is. Just a couple more, getting closer to Christmas, so obviously it's going to be these times where there's just market is all over the place. But here, the day looks bullish, so you might try and go long, but because your daily bias was bearish, you know not to, because if you had go long, you would have got taken out, and there's no opportunity to go short that I can see. Maybe something up here to catch this down, but again, the day looks quite messy, so I just avoid it. And then 26th, bank holiday, no trading volume there. Here, 27th, again, nice bearish day. Daily bias is bearish, so we're looking to go short, and it's really as simple as this. You don't need to overcomplicate it. Just do the same thing every day, and there will be days that trend, and when they do trend, they will most likely be in the direction of your daily bias if you've done it right. If you haven't, then you'll get it wrong, and you can learn from that. Look at different charts, do some backtesting of this, and it does work on all pairs. And we've got a fresh new year for you to start, 2023, so make sure it's a good one. If you do want to keep learning from me, I'm going to have a lot of new content coming out. It will help you on your journey to becoming a profitable trader, funded trader. A lot of new stuff, exciting stuff going to come next year, so make sure you subscribe for that. And join the Discord if you want to ask me any trading related questions, any queries you have, anything you want to learn, just let me know. But before I finish again, look, some days aren't going to be in line with the daily bias. You're going to have pullbacks, you're going to have all kinds of stuff. But it did create a nice liquidity grab for a potential sell. You know, when price goes up during bearish daily bias, something's going on, and you can get in or something like this. You know, sell from there maybe, but we'll have to see what happens next year. But thank you for watching this video. If you did enjoy, then please do leave a like, and I will see you next year.